back to another episode of Your Wealth Health. I'm Eric Brenner. It's great to have you here today. And for the month of February, we're talking about college savings. How to save for college, what are the college savings plans, give you some real thoughts. And as we talked about last week, it's really important not just if you're a current parent thinking about college savings, but also grandparents. So with me again today, I have Bill Davis. Thanks again, Bill, for joining us.
You bet.
So let's continue to talk about college savings and college savings plans, particularly 529 plans. So why don't you explain for our audience today, what is a 529 plan and why should they consider it?
Sure. 529 plan is a state-sponsored education plan, and almost all states have these, and many states even offer a tax deduction or tax advantages to the contributors to the plan. The parent or grandparent is the custodian, so it's not a student asset, which we'll hear about here in a minute. And it can be used for estate planning. You know, we're going to talk about the Secure Act during these three segments, and so sometimes we might want to get some money out of a client's estate, grandparent's estate, and so there's some much higher contribution levels than what we would be normally doing at the parent level, which would be about $5,000 a year.
Yeah. So, we broadcast around the country and people may be thinking, well, what state, what is my state credit if there is? And I know it depends on state, as you said. For Indiana, for where our main office is located, I know it's a credit up to $1,000. So you put in $5,000 into the state plan, you get a credit of $1,000. That's like a 20% return right off the top.
We don't have any investments that are a 20% guaranteed return, and that one is.
Yeah, and so we recommend typically if someone has children or even grandchildren going to school, they can do that all the way through school and even put money in and take it right back out to pay for those costs.
Sure, in some of our surrounding states, example Michigan, you can deduct up to $10,000 off of your state income tax return. And for our clients in Illinois, they could deduct up to $20,000 on their state income tax return.
$20,000, that's a big deal.
That's right.
Yeah. So let's talk about we talked about the credit and all of that, but one of the things that we have available on our site, so I encourage you to go to yourwealthhealth.com, is a plan state by state, just to give you an overview and highlight of what is available. I think, Bill, we're over 30 states now that actually have a state-sponsored plan.
That's correct. Yeah, I think there's only 16 states that don't have some kind of an income tax benefit, and none of those are in our region right here.
Yeah, so certainly something to take a look at. So let's talk about what you can pay for. So if you take a look at the screen, Bill, let's talk about some of the things that you can pay for in or from a 529 plan.
Yeah, I mean, all of your tuition and fees are can be utilized tax-free. So what we're talking about here is withdrawing the money you've saved from the 529 and paying for tuition and fees, books and supplies, computer and internet access, room and board, up to some limitations, and it's a little tricky if you have a student. I know, Eric, you've experienced this with your own students.
Yeah, that's what I was going to say.
Living off campus.
Yeah, so this thing of living off campus, I think this is one that's overlooked. So if you have someone that lives off campus in an apartment like I do right now, one of my sons, you can actually still pay for that apartment or some of that apartment out of the 529 plan. So what you have to do is you have to determine what that room and board would have been at the college. Can't take more out than that, but you can withdraw that out of the 529 plan to help for not living on campus.
Yeah, that's a big deal because a lot of people prefer their student to be, in off-campus housing. Yeah. So back to the chart, for special needs equipment for some students, transportation and travel costs, that's not something that can be taken out of the 529 plan. Health insurance cannot be paid for out of the 529 plan, or college application and testing fees, that's not allowed, nor is extracurricular activity fees. But student loans may be coming into play that with the new Secure Act, that they may allow us to take up to $10,000 a year out of the 529, which will come into play. We've seen this with our parents and grandparents at the end of the student's career in college, they're have extra money.
Yeah, for
And
whatever reason, right?
So the student may
Got
have borrowed,
scholarships or-
borrowed some money, and now they're able to exhaust that 529 plan and pay off some of the debt over maybe a couple of years.
Yeah, yeah. So that's just something, as Bill said, that's just come about. So expected family contribution.
Oh boy, fun topic.
That's a confusing topic a lot, isn't it?
It really is.
So if we take a look at the screen, Bill, maybe just go through what is expected family contribution, and this gives an example of what's included and excluded.
You know, this is important. I want our listeners to really be cautious of this when they go to fill out their FAFSA form, because if you have money in the student's name, it's going to be treated differently than if it's in the parent's name. And we can even move the money around prior to the FAFSA application, but things like you'll see on the slide, both the family and students' income goes on to the FAFSA calculation. The any unemployment or Social Security that was received in the prior year, any bank accounts, brokerage accounts will be on there. But realize that on the right side of the screen, your retirement accounts will not be included on the FAFSA calculation. And the family size comes into play, how many students are in college, that's important. And then if the student is an independent or a dependent student. I will say that a high percentage of the time our students were applying for as a dependent. And getting the independent status is a little bit trickier, so we would recommend they would consult with a professional before they would have their student be an independent. But you could have life insurance cash value, that wouldn't be includable as an asset, and the residence and any consumer debt, that doesn't come into play. But it is something that can be affected. You can increase or lower your expected family contribution up to the date you fill out your FAFSA. So that's important to understand.
And I think another thing is they moved the date. So it used to be, for those of you who maybe remember, a few years ago, it was in the spring or winter, February, right, March,
Yep.
And they moved it to October.
To allow you to use the last year's tax return.
Yeah,
Yep,
yeah.
that is already completed.
So that's an important factor. And the other thing is that we say, to continue to fill it out, right?
Correct.
It's not just a one-time. And I would not assume that, well, I don't qualify. So I think it's worth going through the process, because it is, a formula that gets calculated, and you just never know how it comes out.
Well, yeah, and what I would add to that, Eric, is the fact that if the student ends up going to a very expensive college, you might have a high expected family contribution, but still qualify for grants or scholarships.
Yeah, good point.
So, even if you're a high income earner, we're recommending that they complete the FAFSA.
Yeah, that's a great point. Thanks, Bill.
Yeah.
Appreciate that. So I'd like to offer up everyone that's watching today, have an opportunity to grab this book, which is Say Yes to College and Say No to College Debt. That's always a good thing. Say no to college debt, right? Certainly appreciate you joining us today. Make sure you follow us on Facebook, LinkedIn, Twitter, our YouTube channel. We're out there, and we're constantly giving information. We at Hilltop Wealth Solutions work with and give insight on Social Security strategies, income tax planning, retirement planning, savings, estate planning. So if you have an interest in finding out more, or you really just want a second opinion, we're here for you. You can go on our website and you can schedule an appointment. It's a 30-minute introductory call. We find out more about you, you find out more about us, and we see if we can help you with any of your financial goals. Until next week, for Bill Davis, I'm Eric Brenner. See you next time.